Okay, I'm joined by Rick Palumbi, our Director of Research via satellite from Rick's home office. Welcome, Rick.
Thanks, Kev. Great to be here.
And we're going to talk about fixed income now, which sometimes can be pretty boring and sometimes can be exciting. This last quarter, we had almost like a new corporate bond instrument, introduced into the Canadian bond market, and it caused a bit of a stir and has some implications. So why don't we talk a little bit about that and let our viewers know about that?
Yes, that's right, Kev. Known as the Limited Recourse Capital Note, or LRCN. It is a new type of debt instrument which was approved by OSFI in July of 2020. So far, we've seen banks like RBC, BMO, and CIBC issue these notes. So the interesting thing about the note is that it's a 60-year non-callable debt security sold to institutional investors.
Okay. And I think you were telling me that it's institutions only at this point, right?
That's correct. Yep. No retail investors can buy them at this time. That's right.
Okay. And so what's the big benefit for the Canadian banks in issuing these notes?
Yeah, so there's a couple of things that I think stand out. First of all, the interest paid on these LRCNs by the issuer, the banks, are tax deductible income for tax purposes. And the other is that the LRCN is treated as equity to these banks. So I mentioned it's 60 years, so that if the bank gets into trouble, these notes then get converted into equity. So it really helps out their balance sheet.
Okay. Yeah. Okay. Thank you. And then, like, while these notes were being issued in the summer, they seemed to act as a catalyst for the preferred share market, which to that point was fairly depressed, and the preferred share market has been, quite strong and recovering almost all of its losses for the last couple of months. But it seemed to be triggered from these notes being issued.
Yeah, I think what the preferred share market was thinking about was that if banks use these vehicles more and more because of the benefits that I mentioned, then they will issue less and less preferred shares going forward. In addition, they will call some of these preferred shares that don't count as capital and take those off the market. So net, there have been estimates of 11 or 12 billion dollars that might be removed from the pref market, and so you have some scarcity in terms of issuance going forward, and also scarcity of the preferred shares that are left on the market. So investors got excited about that, and obviously drove the market higher. The debate will still rage about that, but clearly preferred shares were very depressed, and this acted as a catalyst to move the prices higher for sure.
Okay. Now, in this pandemic economy, bond yields, as we know really well, have absolutely collapsed, and they really haven't come up much. So, in our last outlook, we talked about, investors trying to find income, and that theme really hasn't changed in 2 or 3 months, has it? It's still
Absolutely.
a struggle to find income out there. So, how are we looking at that? And I'm kind of curious if we're buying into these LRCN notes.
Well, for us, it's all about risk reward. So when we look at these notes, as I mentioned, the notes are 60 years in maturity. There's no call date, and they reset every 5 years. So much like preferred shares, you still have this reset risk, and very interest rate sensitive over a 5-year rolling period. So that has not changed. The only difference is that for a credit purpose, the LRCN ranks higher in the capital structure. But when we look at the interest rate differential, to us the risk reward doesn't make a lot of sense. For example, LRCN from Royal currently trades at about a 4% yield to maturity. That's about a 2.5% after tax yield. Whereas you can buy a pref with that's yielding about 6% to reset. And, with the tax difference, you're actually looking at an over 4% yield. So that's, for us, that's a big number. And for our clients looking for income, that's a big number. And so on top of that, you have potentially more upside from different catalysts coming in. So for us, the LRCN at this point doesn't make a lot of sense. It doesn't mean that, going forward, we wouldn't necessarily add it to the portfolio. But at this point, the risk reward for preferred shares looks more compelling to us.
Okay, yeah, I just did some quick math, Rick, according to your numbers there, and basically after tax, we're getting over 60% more income, holding preferreds right now versus these LRCN notes. So that's pretty significant.
It's a big number. It's a big
Yeah.
number for sure.
Yeah. So, okay, no, that's excellent. I know it's a complicated new structure. You did a great job explaining to us and keeping it simple, and it's good to hear it's providing a much needed tailwind for the preferred share market. So thanks very much.
Thank you, Kev. Appreciate it.